Everyone's telling you to move your bank account into a trust, and honestly, it sounds like the financial cheat code you've been waiting for. But what if the shortcut you think you're taking is actually a trap door? Let's set the stage. There are over 77 types of trusts recognized in the United States, and every single one of them falls into one of two camps: revocable or irrevocable. The post that's been making the rounds on your feed is almost certainly talking about an irrevocable trust. And that's exactly where things start to get interesting. Here's the problem nobody's explaining to you in the comment section. It all comes down to something called incidence of ownership. If you're the trustee, the beneficiary, and the person still controlling everything, congratulations, you haven't protected yourself. You've just renamed your bank account with extra steps. Courts see this move all the time, and they have a word for it: a sham. And no, that's not us being dramatic. That's the actual legal standard judges apply when they unwind these structures and hand your assets right back to whoever was suing you. The law doesn't care how many notarized pages your documents have if the substance says you never actually gave anything up. Now, to be fair, we don't have the full context of every post or guru out there making this claim, and some structures genuinely do work, but the devil, as always, is in the details. What we can tell you is that irrevocable trusts live in their own separate tax universe, and that universe has some brutal rules you need to know before you sign anything. There are only 4 tax brackets inside an irrevocable trust, and the highest marginal federal income tax rate kicks in at just over $15,000 of retained income, $15,000. Meanwhile, an individual doesn't hit that same top rate until they're earning over $600,000. So the math can turn against you shockingly fast if the trust is holding income-producing assets. This is the part where the sound smart strategy starts feeling a lot more expensive than advertised, and it's the part nobody's putting in their 60-second video. You can accidentally trigger serious tax consequences without realizing it, simply by leaving money sitting inside the trust at year-end, and your accountant will not be thrilled. Now, yes, there are offshore trust structures that offer genuinely powerful asset protection, and some of them are completely legitimate, but as a US citizen, the IRS follows you across every border on the planet. Offshore does not mean invisible, and it certainly doesn't mean untaxed. Here's the most important thing we can tell you today. Go to irs.gov and search the phrase abusive trust tax evasion schemes. It's all there in black and white, documented, categorized, and actively prosecuted. The IRS has an entire division dedicated to unwinding exactly the kind of structures being casually promoted on social media, both domestic and international. History is full of people who thought they'd found the loophole, paid someone a few $1,000s to set it up, and then spent $100,000 defending it or lost everything trying. The lesson isn't that trusts are bad. The lesson is that a trust is only as strong as the legal and tax foundation it's built on. So what's the actual takeaway here? Work with a qualified estate planning attorney and a CPA who specialize in trust law before you restructure anything, because a properly designed trust can absolutely be a powerful tool, and a poorly designed one is just risk wearing a suit. The strategy isn't wrong. The execution without expertise is. Discipline in this space means doing the boring work first, vetting the structure, pressure testing it against audit scenarios, and making sure it holds up in a courtroom before you ever need it to. Position size matters here too, because the cost of setting up and maintaining a legitimate trust structure needs to make sense relative to what you're actually protecting. At the end of the day, real asset protection isn't about sounding sophisticated at a dinner party. It's about building something that actually works when the moment arrives. The best structures are the ones nobody ever hears about, because they never ended up in front of a judge. Whether this particular approach is right for you depends entirely on your situation, your goals, and the quality of the professionals guiding you, and we're completely comfortable with whatever conclusion you reach after doing the real homework. If you want help navigating real estate investing, finding the right contractors, or connecting with lenders who understand how these structures interact with financing, check out the links in the description below.